Welcome to this explainer. Today, we're diving straight into one of the most heavily debated stories in the market right now, Nike, ticker symbol NKE. We're going to objectively break down this brutal 35% year-to-date decline in Nike stock. We want to see if this is a once-in-a-generation buying opportunity or if it's a classic value trap, a falling knife that's just going to keep on dropping.
Here's our roadmap for today. We're looking at the fall of Nike, the generational buy, the value trap, Wall Street consensus, and then the final verdict.
Section 1, the fall of Nike. How did we get here? Just look at this, minus 35%. That massive year-to-date drop really paints a picture of the pain investors are feeling right now. To put that into perspective, this stock has basically wiped out an entire decade of gains, dragging its valuation all the way back down to 2014 levels. Ouch.
So let's trace the timeline of this massive restructuring. First off, in their recent quarter, Greater China sales fell by 12%. And this wasn't an accident. Nike is aggressively resetting, literally cutting off major distribution agreements with longtime partners to pivot hard toward a direct-to-consumer model. Jump to the present day, and they've brought veteran executive Elliott Hill back as CEO to steer the ship. Looking down the road, they're slashing their U.S. store footprint by about 10%, and that's expected to drag out and hit the results until at least mid-2027.
Now, what's really fascinating here is the sheer contrast between the long-term vision, what they're calling the win now strategy, and the agonizing, completely self-inflicted short-term costs. Moving to that direct-to-consumer model, that creates an immediate $1 billion revenue headwind in China alone. Think about that. That's roughly 20% of the region's sales. Throw in that 10% cut in North American stores, and we're watching a legacy giant intentionally shrink itself in the short term just to try and build a stronger foundation. Section 2, the generational buy. Why you would buy. Let's give the bulls their moment. Why are some folks eagerly scooping up these discounted shares? Well, Morningstar still sees a wide economic moat for Nike and finds deep value here, giving it a $94 fair value estimate. If that plays out, we're talking about the stock basically doubling from these current levels. On top of that, technical traders are eyeballing that $40 52-week low. That's a classic zone where exhausted sellers finally give up and strong support kicks in. And then there's this absolutely staggering number, 407%. Despite all the shrinking revenues and the doom and gloom headlines, Nike actually shocked the market by posting a massive 407% year-over-year jump in net income in their fiscal fourth quarter, easily beating expectations. But wait, there is a pretty massive catch here. A whopping 72% of that earnings beat came straight from a one-time tariff refund of $986 million. Yeah, essentially a giant billion-dollar refund check just padded the entire quarter. So to be perfectly clear, that was a one-off event. But if you're a bull, you look at this and say, hey, it still proves the company has the raw mechanics to generate huge profit when the stars align. Because ultimately, guys, this is still Nike. They maintain unparalleled global brand equity, right? And this direct-to-consumer strategy is explicitly designed to unlock higher long-term margins and give them way more control over their customer base. The whole bull case really hinges on this. Are you willing to stomach 2 to 3 years of absolute pain to own an undeniable world-class brand at a deep discount? Section 3, the value trap, why you would sell or avoid. All right, let's flip the coin and look at the bear case, because the skeptics are bringing some incredibly alarming structural arguments to the table. JPMorgan actually downgraded Nike to a sell equivalent, literally warning that earnings pressure is going to stick around all the way through fiscal 2028. And Citi, they point out the stock still trades at a rich 21 times projected fiscal 2027 earnings. So what does that actually mean for your wallet? It means a full recovery might already be fully priced into the stock you're buying today. Paying a premium like that for a mature company facing this much uncertainty, well, that's a really tough pill to swallow. And then we have the competition, which is absolutely fierce right now. Nike is honestly bleeding relevance with younger consumers. It's a classic story. You've got this massive legacy giant stuck in restructuring mode, while these super agile competitors are just ruthlessly eating their lunch. On Running is grabbing market share with cloud tech. Hoka is completely dominating the running category. New Balance is staging this massive comeback. And over in China, local powerhouses like Anta and Li-Ning are actively snapping up the market. Adding fuel to the fire, we've got some serious red flags in leadership. When you see executives actively selling off shares, and a major player like the chief accounting officer just resigning smack in the middle of a turnaround, that absolutely rattles investor confidence. The bears are simply asking, why park your hard-earned money in a stock fighting intense structural battles when there are clean, straightforward growth stories everywhere else in the market? Section 4. Wall Street Consensus. The Split Opinion. Let's look at how the biggest banks in the world are placing their bets. Look at how incredibly divided Wall Street is here. JPMorgan says sell at $40, right around where it's currently trading. Wells Fargo and RBC Capital are sitting right in the middle with hold equivalents. Citi is neutral. And then you have Morningstar standing completely on their own, screaming buy with a massive $94 target. There is literally no consensus here, which just goes to show how high risk, high reward this whole situation really is. If you average all those targets out, you get $50.66. That average one-year price target implies about a 25% upside from current levels. But remember, that range is wildly wide, and the most bearish targets sit exactly where the stock is trading today.
Section 5. The final verdict. What's the move?
Let's pull all this together and figure out what you should take away from this incredibly complex financial story. The reality we're seeing from the data is that Nike is probably making the right long-term moves. Direct-to-consumer is absolutely the future, trimming underperforming stores makes sense, and resetting China builds a cleaner foundation. But the elephant in the room is the timing. This turnaround is going to take years, not months. You really have to weigh the opportunity cost for your own portfolio. Could your money be working harder in companies that are crushing it right now instead of sitting through years of painful volatility waiting for a recovery that might not hit until 2028? Honestly, unless you've got a 5 to 10-year time horizon and an absolute iron stomach to handle further drops, the smartest, most objective move based on the data right now is to just keep Nike on a watch list. Wait for actual hard proof that this win now strategy is doing what it's supposed to do. Look for that undeniable confirmation, like a quarter where China sales finally stabilize or US sales show actual positive growth before you go rushing in to buy.
Because at the end of the day, this is a story stock, and stories take time to play out. You've seen the painful short-term headwinds, you've seen the fierce competition, and the fiercely divided Wall Street targets. But you've also seen the massive long-term brand equity and the vision for the turnaround. So I'll leave you with this. Generational buy or value trap? What's your move? Are you buying this dip, or are you staying far, far away?